A new question is popping up over and over with our clients, and that is, what do we do with a property that's sitting on the market that won't sell, and we know it's going to be negative cash flow if we do a loan with it? So the question is it smarter to leave it on the market, keep dropping the price, or take it off and make it into a rental now before rates go up and even prices go down farther? And that's what we're going to go over today, the numbers behind it, how you can look at it quickly, and a few tricks that you should make sure you're doing and not doing to make sure you get the best rates and the best deals to make this property cash flow. So the hurdle that people keep coming upon is if we take this property and we move it off the market, it's going to be negative cash flowing because maybe the price is too high, maybe the rents aren't there yet. But the truth is, this property is a negative cash flowing property now, because every month you're paying the current lender interest that is just going away. It's not adding to the value. It's not going to do anything but enrich them and make you a little bit poor. You already have a property that's a negative cash flow property. Maybe it's better to take that negative cash flow and bring it down to a more manageable number. Typically what we see is that people spend more in 2 or 3 months leaving it on the market than they would by taking the property off the market, make it into a rental, and having a lower negative cash flow every month. Typically what we find is that people spend more in keeping the property on the market for 2 or 3 months with that money that they're paying out where there's no money coming in, so their negative cash flow is even higher than even taking it off, taking a smaller hit every month on that property, getting the rental income in, and hopefully selling that in 2 or 3 years when the markets come up or the rates go down and you can refinance it again. You know, a lesson learned back in 2008 and 2009, the majority of properties, if people would have just kept them for 3 to 4 years, they would have been back in the money. Not only would their property values have gone up, but also rates would have come down and rents would have increased. So those would become assets instead of taking that hit and maybe even losing money or putting a property in foreclosure. What are your options if you have a negative cash flowing property? Or we also hear people are talking about buying properties that have a ton of equity, but they know they're going to negatively cash flow. Let's go over the negative DSCR and the no ratio loan programs, because what they do is they allow you a 30-year fixed product that can be interest only, even if the property is not cash flowing. Typically a DSCR loan, your payments and your rents have to at least equal. They have to be 1 and 1. Your outflow has to equal your inflow. But there are options out there. They're called negative DSCR or no ratio loans that allow you to refinance rental properties even when the cash flow is negative, which means you're bringing in less rent than you're paying out monthly in interest, taxes, and insurance. And yes, DSCR or no ratio loans are typically better than using your current lender to keep refinancing, because you don't know where the market's going to be in 12 months or even 24 months. We know long term the markets will come back, but what if that doesn't happen for 3 years and you're in a bridge loan that's refinancing every year and you're paying those points every year? So that's why you look at an option like a DSCR loan. You just have to know your numbers. Let's go through an example so you know exactly how to calculate what you're looking at and if it's smart for you. Let's look at an example of a $300,000 loan. And we're not going to worry about what the value is or the price, but one point here that you need to understand is stop dropping the price on the MLS, because every time you drop it, it hurts your chances of getting a better rate or a better product when you are refinancing. This $300,000 loan in our example has a 10% interest rate going with their flip loan. Every month they're paying out $2,500 in interest. $300,000 times 10% divided by 12 is $2,500 every month they're paying out just in interest. So this property is negatively cash flowing already because it's sitting on the market and they're not bringing in any money. Let's now look at the example of taking that property off the market, putting it into a DSCR loan with interest only at 7%. If you rent the property for $1,800 a month and you have an interest rate of 7%, you're going to calculate your payments of about $1,750 a month. That is $300,000 times the 7%, since it's interest only, $21,000 a year, $1,750 a month. So it looks like right now you're bringing in $1,800 a month in rent and outgoing is $1,750. So you have $50 in positive cash flow based on your mortgage and your rent. But you still have other factors to consider, which are taxes and insurance. If your taxes and insurance are $300 a month, now you have outflow of $1,750 and $300. So you have a total of $2,050 going out every month, and you have rents coming in of $1,800. So you can see that this property has a negative cash flow of $250 per month. That $250 over 12 months is $3,000. Over 2 years, that's $6,000. So remember, go back to our example. As the property sat on the market, we had $2,500 a month going out just in interest to the lender that doesn't get us anywhere. On top of that, remember, we still have the $300 for taxes and insurance. Even 1 month with that property sitting on the market at $2,800 per month almost equals the $3,000 over a year. Keep it on there 2 months, it almost equals 2 years. So you can see how this factors in and how you have to look at this and determine, is it going to be better to keep this property and have a little negative cash flow over the next 2 to 3 years and hopefully recoup that 50 to 100 grand in equity when the markets come back, or even refinance it into a lower rate term when rates come back down? Because sooner or later rates will come back down, home prices will go up. It has proven itself over history. So looking at putting a property like this into a DSCR or a no ratio loan makes a lot more sense than keeping it on the market, paying that $2,800 per month and going nowhere but down. You need to act quickly because rates are going up, prices are going down. There are options out there. There are these options for you to get into a 30-year loan. And the reason you want to get into a longer term loan, even if it's a 5 or 7 year, but you at least want to get into that term to let the markets come back. Because if you're always going to just get into a bridge loan with your current lender, and we do bridge loans, we love bridge loans, and not for this scenario. Because the markets may not come back in a year. It may take 3 or 4 years. You need a product that's going to lock you in. And if rates go back down, you could always refinance. But you want to be locked in so you're not refinancing every year, paying those points, paying those closing costs on a bridge loan. These products do not require you to be in business for 2 years. It doesn't require you to have income, personal income, or business income. These are ideal for these properties, these flips that are sitting on the market that have become flops. Make that into a positive by turning it into a rental. An important thing to remember about these no ratio and no DSCR loans, there are going to be maybe some LTV hits compared to regular DSCR. So make sure you check with your lenders. We'd be glad to help you. We look at over 100 different products every month just for investors, trying to find the ones that have the best terms, the ones with the lowest down payments, the highest LTVs, the best rates. If you want to, reach out to us. We'd be glad to run the numbers for you, see if it makes sense. We're here to help you find the loan that puts you in the best situation. We bring you this content because it's what we hear from our clients. We know this could help the right people. If it helps you, help us by liking it and sharing it, because we want to get this out to as many people as possible. We understand people are hurting right now because they're sitting on properties that cash is going out and it's not coming in. We want to put you in a situation where those numbers decrease a lot and you can get back to profitability on other flips.